Brought to you by the OR Group, connecting people, projects, and capital to find the next generation of minds. My name's Mark, and you're watching Resource Talk's weekly news roundup for the week ending August the 2nd, 2026. This week, a divided Federal Reserve kept interest rates unchanged, but opened the door to another hike. Microsoft recorded the largest one-day increase in market value in history, and gold climbed back above $4,100 an ounce as investors weighed persistent inflation and geopolitical risk. And joining us to make sense of it all is Clem Chambers, veteran markets commentator and an author. Clem has spent decades analyzing stocks, commodities, and cryptocurrencies, and is now the founder of private investor platform A New FN. And at the end of the conversation, I'll ask him how he would invest $100,000 in this environment. So Clem, thanks for being here.
Great to be here, and I'm happy to have some spicy tips at the end. They're not tips. Okay, well, it's not financial advice. It's raw material for financial advice.
Good. So, Clem, the Federal Reserve left interest rates unchanged this week, keeping them between 3.5 and 3.75%. But it was hardly a reassuring pause, with three policymakers voting for an immediate rise, while Fed Chair Kevin Warsh gave investors very little guidance about what comes next. And in that sort of information black hole, markets briefly put the chances of a September rate rise as high as 77%, which sent bond yields climbing and put stocks under pressure. So, Clem, was this effectively an interest rate rise delivered through words rather than action by Walsh?
I'd say it's the opposite. Oh, I'm not going to tell you and give you guidance that we're raising interest rates. So when I drop them, you can't say you said the opposite. I mean, this guy is meant to be a hawk. Oh, yeah, sure. Of course he is. Trump got a hawk to be the Fed chairman. Oh, of course he did. He would want that, wouldn't he? He'd want a hawk. He's a tight money person, not. What did he say? I'm a low interest rate kind of guy. I think that's to quote unquote. So, yeah, of course he's hired a Fed chairman that's going to be a hawk and put interest rates up. Of course he has. Of course he hasn't. But of course you can't say, well, actually, I'm going to be very dovish because there's all this stuff coming up we can't really talk about. And we're going to be printing like crazy. And the last thing in the world is I want to set interest rates going through the roof by saying we're going to drop them. And I'm just going to say, oh, hard to give guidance. Oh, very hard. Hard. Oh, so hard. Oh, no. Oh, no. What could it be? Oh, we are feeling hawkish. Oh, yes, we are. Oh, yeah. Because the best way to make interest rates go down is to say they're going to go up. Yeah. And then, if you say they're going to, we're going to be loose money, everyone goes, oh, my God, inflation. Oh, we won't lend money. Oh, no. And up goes inflation. Up goes interest rates. So they're caught between the devil and the deep blue sea because there ain't going to be enough cash to go around for onshoring. I mean, reindustrialization, how much cash do you think that's going to need? Oh, AI, oh, another load of billions and trillions. Oh, we're going to need to build our energy infrastructure. Oh, that won't need any new money. No, we won't have to print any for that. No, that'll just kind of exist and come out of nowhere. Yay. They're going to have to print like crazy. Absolutely like crazy. It's going to be a printathon for what? 10 minutes, 10 weeks, 10 months, 10 years? When are they not going to have to print like lunatics if they're going to onshore industry, if they're going to build out AI, if they're going to be energy dominant? Trump has said it. I mean, it's not like these guys don't say it. If you read Mein Kampf, Hitler said what he was going to do, but nobody believed him, right? Xi says he's going to take Taiwan. Nobody believes him. They tell you. And Trump and his crew have said what they're going to do. They're going to onshore industry. They're going to build out AI. Yeah. And they're going to do all those things. And they all need money. Tons and tons and tons of money. Energy dominance. Remember they said that? Do you know how much more energy China has over America? 250% more electricity. 2.5 times the electricity of China. So how's America going to be energy dominant without building, like, how many? I think they're building 50 nuclear power stations in China right now. And 50 or 75 coal-powered power stations right now, which is why they could afford to stop bringing in oil when the Hormuz situation kicked off, because they've got energy coming out of their ears. And because energy is life, energy is economics, energy is power. And they've got 2.5 times more than America. So America's got to catch up, 2.5 times more electricity. How much money do you have to print to do that? I mean, think about how much new money you're going to need just to build that power grid, let alone the AI grid, let alone onshoring all that manufacturing. They just banned robots. I don't know if you saw that. America's banned Chinese robots. Why? Because America is so far behind China on robots, they have to ban them so that American industry can catch up. Because the future is re-onshoring manufacturing with robots. Guess what? China's got 100 manufacturers, apparently. Maybe it's a lie, but they've got many manufacturers of humanoid robots right now. You can actually buy one right now on Amazon. I think you can still buy on Amazon, but you certainly buy it in a robot shop. $18,000 for a robot, a humanoid robot, now, today. Not Tesla's robot, which is going to be the next wave of Tesla's value add. Remember that? Remember that old chestnut? Well, where is it? Well, I know where the Chinese one is. It's down the store. All I've got to do is get my Amex out and I can have one. So they banned it. Because if they don't ban robots from China, they ain't going to have no robot industry, are they? They ban cars. Chinese cars are banned in America. Go look it up. Why would that be then? Because there wouldn't be a car making industry in America if they let the Chinese cars in that are better, half price. Better than half price. Half price. So what's Ford going to do, which are now making military vehicles again? Oh, funny that. Yeah. So when you put all these pieces together, you know, they're going to be printing like there's no tomorrow. How are you going to have a robot industry unless you fund it with tens, hundreds of billions? How's Walmart going to get its bonds when all these technology people are taking all the cash out of the system? Oh, yeah, we're building some service centers. Yeah, give us 100 billion. Yeah, thank you very much. Ka-ching. Oh, yeah, give us another 100. Yeah, we'll pay up for that. Don't worry. We've got amazing cash flow. Yeah, we'll have that. We'll have that. Hello, I'm Walmart. What do you mean there's no money to be had? What do you mean the hyperscalers took it all? What are we going to do then? Well, you know, they're just like, some more for you. Have some more. Have some more money. Yes, indeed. And of course, that's going to create an economic boom and high inflation and high gold and all the things that come along with that. Now, if Trump and his family get kicked out and they all end up going to jail and another side gets in that doesn't believe in that, then, well, you know, that'll be a different story altogether. But if America's going to retain its dominance or get it back, or however you want to look at it, it's got to print like it's at war. And that's very, very inflationary. Not hyperinflationary, but not runaway inflationary, but high. And you can't have that. You can't have the money unless you print it. That's how it works. In a wartime, they print money like crazy. And at the end of the war, all of a sudden, all the prices have been rebased. Yeah, and we are entering that phase right now. And they were QE. They're just QE. That what people don't understand about the American debt is that it's a wondrous thing. It's a savings account, actually. Oh, no sacrilege. No, it's not. Yes, it is. Because when you print a bond in America, it goes to Americans. 75% of the people that get that bond are Americans. So it's a bit like a pension for rich people. Americans buy American government bonds, and then America gives them 5% on the money. What could be better? And then when America needs money, it prints confetti, takes their bonds back and sticks it in a bottom drawer. That's QE. And I don't know how many $1 trillion of American debt is in the bottom drawer of the Fed, but it's many trillions. I think it's about 4 of the national debt, American national debt, is in a bottom drawer at the Fed. Of course, it's not the government. Oh, no, it's a private company, you know. Yeah, right, of course it is. So anyway, QE turns that debt into confetti, and that goes into the economy, and Walmart can borrow money after all, because there it is, it just got printed. And the government debt goes in the bottom drawer again. Yeah. American debt, only 25% of that 40 trillion is owed to anybody outside of America. 10 trillion. So national debt ain't 40, it's 10. Well, the national debt to Americans is 30, but the Americans own the debt of their government. So, you know, it's like a reverse taxation, actually, for the rich. The rich get some cash back. You've made that money, you naughty, naughty rich people, give us it back, and we'll give you 5% on it. Yeah. You only get in trouble, where you really get in trouble, is if you're Argentina and your whole national debt is owned to foreigners, and you can't print the currency that you've borrowed in, like the dollar. Oh, I'll lend money in dollars. Can we have them back, please? No. Can't you print some? No. Oh, you got a problem then. America. Hey, can we have one of it? Sure. How do you want it? In cash. Sure. Hey, print some, will you? Hand it over. Yeah. So, but that is, like it or hate it, a reality. And that is also inflationary, absolutely inflationary. And there's no going back now. We are going to get high inflation, 5 to 10% forever now. And that's a big deal.
The ore group advances metals projects through exploration, discovery and development with one objective: to deliver the next generation of mines. They focus on what matters most: the right people, the best projects and access to capital. Discover their companies at oregroup.ca and subscribe to the core report for free to receive updates, timely market insights and early access to updates. But the contrast with the previous period when the Fed was doing QE would be that currently inflation's above target, we've got oil prices rising, and we've also got a lot of Fed policymakers who are calling for higher rates. So there doesn't seem to be the same consensus for lowering rates.
I'm not going to say it, are they?
To printing.
Would you imagine that they could possibly say what I just said? They can't say it, can they? They can't say it. Well, China makes robots and we can't, and they've got all the industry and we haven't, and they've got all the energy and we haven't, and if we're going to catch up, we've got to print money like no tomorrow. They're not going to say that, are they? They're going to say, oh, yes, we're going to be good. We're going to be fine. It's all great. Yeah, we're the number ones. Yeah, we're great. Oh, everything's going to be fine. We're not going to have inflation. You la-di-da. I mean, politicians would never mislead you, of course. I forgot that. So you're right. Politicians and people in government would never mislead us. There's going to be no inflation. They're going to be hawkish. They won't be printing that money. Walmart, they can go bust because they can't get any bonds. That's the market for you. We don't bail people out. No. Not going to do that.
So you don't think the Fed's real objective is price stability as they claim it to be, but instead you think that they're going to be cooperating with the US government's political ambitions, which is something they shouldn't do as an independent. Go on.
Let's look at it another way. Jay Powell didn't play ball, did he? What happened to him? He got under criminal investigation from Trump. He didn't play ball. It's not like he didn't play ball much, or he did exactly what Trump didn't want. He didn't do what Trump wanted, and he got under criminal investigation. In America, they will sue you as a criminal if you go against the people in power. And you can see that with what Biden was doing to Trump and what Trump's been doing to his political enemies and what they did to Clinton, et cetera, et cetera, et cetera. Yeah, if you don't go along with the people with the political leverage, you end up in criminal proceedings. And Jay Powell, who's basically, an angel, who'd bailed out America so many times from melting down that I lost count. He doesn't play ball with Trump, and he gets under criminal proceedings. So anyway, he's gone, and you're offering me the job, Donald. Thank you very much. And I don't agree with you, so I'm not taking that bloody job because you're going to put me under criminal investigation and destroy me. So who's going to agree to take that job? An independent person that's going to disagree with Donald Trump, who clearly is a low interest rate kind of guy, who says run it hot, who says reindustrialize, who says we need energy dominance. He's going to put his head in that noose? No, he's going to say one thing and do another, isn't he?
Let me ask you about another headline from this week. So Microsoft shares jumped more than 15% after the company reported stronger than expected growth in its cloud business. And the surge added roughly $450 billion to Microsoft's value in a single day, which is the largest one-day gain ever recorded by a company. But Microsoft and the other hyperscalers are also spending enormous sums on data centers, semiconductors, power generation, transmission lines, cooling systems. And Clem, you've argued that the more durable investment opportunity might lie in the underlying infrastructure rather than in the companies that are developing the models, the AI models. So
yeah, all the way down.
What's the investment opportunity for a resource investor?
Well, I mean, I'm exceptionally bullish in copper. And I was starting to be a little bit less bullish in copper. Because you could say, well, it was, $3,000 or $4,000 a ton not that long ago, and now it's 13. And for me, it's going to go to 40,000, maybe a lot higher. Yeah. But didn't seem to me that the penny was dropping. And sometimes you go, oh, maybe I'm missing out. Now, so I did some more research, and there's not a great shortage of copper. There's not a great shortage of copper, but there is a shortage of copper, and there's going to be a shortage of copper. There's going to be a massive shortage of copper. And I was chatting with a big metal trader, like one of the biggest. And we were talking copper, and he just said, oh, it's just going to go nuts. It's just going to go off the dial. So it gave me a little bit more fortitude. So, I just don't, it's like, okay, in the model that I just said, which is not the model in the mainstream narrative, which, should make people pay attention, really, because the mainstream narrative is normally trash. And that is, America starts building out, all these resources are going to get tight, very, very tight. And actually, if you go back and look at where all these resources come out of, it comes out of China. China have got an 80% of the processing of raw materials into materials, primary raw materials into raw materials, if you want to look at it, So when you dig out a load of copper concentrate, it's the Chinese that turn it into copper. Not strictly true with China, but nonetheless, all that stuff, they are the workshop of the world for resources. And so even if they just don't say, boo sucks, you can't have any, which is a risk, they've just done that to half a dozen rare earths, yttrium and stuff like that, gadolinium, germanium. Oh, no, so you can't have any now. Make your own. Go on, bugger off, make your own. Oh, we can't. We haven't got any processing. Oh, yeah. If you take that out, and China are all big buddies, and by the way, as a sub-bar to this, thank goodness President Xi is going to New York in September or whenever it is. Thank goodness for that, because that means hopefully this banging heads with China is not going to turn into something horrible, and that they'll just agree to disagree and compete like crazy, not blow each other up. Yeah, so it's fantastic that Trump has got Xi to that point. But even if everything's all la-di-da and cooperative, the build out of AI and everything that goes along with that is just going to suck up all these raw materials, and they're going to go away. They're going to stop being old-fashioned meaning of commodity. They're going to start becoming luxuries. Many of them already are. I mean, you're looking at $500,000 a ton for some of this stuff now. I mean, $500,000 a ton, that's a serious amount of money. And they weren't. They were like $20,000, and now they've 10x'd. And a lot of things are going to do that. Things like secondary things like cobalt, let alone the rare earths, scandium, let alone the rare earths aren't rare earths really, but are similar. all the crazy stuff in the high tech stack. So really, it's a matter of getting exposure to this stuff. And I was talking about a particular metal that I won't mention, and it was like, well, I can't get hold of it. I can't get a position in it. I mean, I don't want a warehouse full of it. I want a nice, neat ETF or whatever, or a nice, a CME position. I can't get one. There isn't one. It's going to go ape, and it's going to go. And it's very hard to get proper exposure on it. Oh, you can buy a miner. And they found out I haven't got any. So, there's very difficult to get clean access to a lot of these metals. So, in a sense, most people are restricted from what exposure they can get to resources, because a lot of the resources that will go ape are simply not traded in the way that, say, copper is, or even the rare earths. You have we have a difficult exposure to it. But there's a load of stuff that's much, much harder, much, much harder.
Well, with rare earths, I think I read that you're a co-founder of Silex World, which is a developing technology to recover rare earths from discarded magnets and industrial waste. Is that right?
Yeah, we're building plants in India on that. And the difficulty is with all this stuff. If I went to Holland and I said I want to build a rare earth processing plant, they'd all have a heart attack. The hair would stand on end, and they go, oh my God, oh, the environment, oh. Which, of course, is one of the reasons China has a lock on it, because they don't care. And they can get on with it. And one of the good things about India is that they move at a great pace. And they're quite, they've already got lots of infrastructure that have already got all the things that you need to have to start doing like rare earth processing. They've already got the infrastructure, the industrial heavy industry infrastructure. There ain't much heavy industry infrastructure in Britain. America has got lots of space and lots of Rust Belt stuff where they can do stuff, but in Europe, a lot of it's gone, and long gone, and all it is now is a bushy wilderness. That underneath it is a load of 1925 waste dumps or whatever. There's no actual live infrastructure, or very little live infrastructure to actually build out on, and we're hopefully we'll be doing something in the UK not too distant future. And that's something that will make it quite well. We have to put a lot of effort and focus and planning into getting going. Whereas, in various other places in the world where they can say, see that where that steel mill was last week, you can do it there. It's got all the pipes, it's got all the drainage, it's got all the cleaning, it's got all the scrubbing, it's got all the dumping, it's got all the conveyor belts, it's got all the tipper trucks. Yeah, in the UK, you'll go to Corby and you'll find some treed hills that once were a coal mine 30 years ago or something, So a lot of places, particularly in Europe, they have a difficulty in putting in place the processing of primary activities, which they handed off basically to China. And now China's got a little bit spicy about things. They, it's difficult for them to actually do anything about it.
You argued that America can't afford to lose the AI race to China, and that they could ultimately end up creating money in order to fund continued investment. And you've said that that could lead to high rates of inflation. So if that happens, how do you think resource investors should balance exposure to commodities consumed by the AI build-out, like copper that you mentioned, against monetary hedges such as gold? Do you think they should be holding both?
Silver, I'm told, is very key to AI. I'm not so sure. And gold and silver have done their vertical. Yeah. So they did their vertical, and they're going to be resting for quite some time now. So in a sense, you need to find things that are going to be doing a vertical that haven't done it yet, which I would say, for example, copper is one of those things. And that vertical will come. So it's about getting exposure to it, and also being able to get liquidity at the right time to take your profits. Because the mistake that a lot of people make is they believe in the story like copper. Copper goes through the roof, goes to 40,000, and then they say it's going to go to 100,000. And if it goes to 60,000, they say it's going to 200,000, and they never get out. And it goes all the way up and it comes all the way down again, like you saw with silver. It hasn't come all the way down, but it's come down a fair way.
So you mentioned gold. Let's talk about the yellow metal, because it climbed back above $4,100 an ounce this week after the Fed left interest rates unchanged and investors started reducing their bets on a September rate rise. So where do you see gold going over the rest of 2026? And what do you think are the biggest drivers right now?
Well, my target is down to 3,500. And I think that is in and around the bottom. Now, talking of big ass traders, they were saying, oh, why wouldn't you start buying it now? And I said, yeah, well, I suppose so. It's going to be way higher at some point than in the medium term, which is what a lot of your viewers won't care about. They won't care about 5 years' time. And, in 5 years' time, it will probably be a lot higher. Yeah. Or it will have been going sideways for 5 years and be about to explode and go to, 10,000 or whatever. In the medium term, it's going to go a long way. In the short term, I think it's noisy. You could put it that way. It's going to go, to me, it's going to go down to 3,500. And if it doesn't, I'll be DCAing it next year sometime. Yeah, DCA, dollar cost average. Because as far as I'm concerned with gold, if you're a trader or a speculator, you dive in and you dive out. Oh, I bought it at 4,000. I sold it at 4,200. Oh, I'm clever. Well, you made 5%. Nice. But that's not about gold. That's about speculating in a financial market, which is not the same thing at all. So if you believe in gold, and it's about gold rather than about clipping some money out of the financial market, then it's a long-term buy. It's got to bottom, and I wouldn't doesn't look like a bottom to me. And I think that bottom is around 3,500, could be a bit lower. And then, because I would be buying gold because it's about gold, I would just, buy a lump and then buy another lump in a few months and then buy another lump in a few months. And if I get a little bit excited, I'll buy 2 more lumps and then I'll buy another lump. So I'll be buying lumps for 3 or 4 or 5 years and I have a blooming great lump like I had before it went up last time. And then when it goes up, I go, oh, goodbye. And so, I will be lumping in. There we are, I've invented a new catchphrase there. I will be DCAing in gold either after it gets to 3,500 or in the middle of the year when it's gone, dare I say it, limp. When it's just going, and everyone's going, oh, I don't care anymore. And then I'll be buying. I want to buy when nobody wants to buy. And I'll be selling when everybody wants to buy. Yeah. And that's coming. It could be soon. It could be later. It's definitely going to be there middle of next year. And it's definitely not going to be 6,000 by Christmas. Well, not this one anyway. And that's what everybody wants to hear. I could say, gold is going to go up back up to 5,500 in the next 15 minutes. I can assure you by Monday. No. It's going
that quote's going to be the title of this video.
That's right. 5,000 by Monday. So it's going to go like that for a bit more, and then it's going to go like that for quite a long time. To you, it'll look like that. To me, it'll look like that. And then suddenly, at some point, it will go like that. And, hopefully it won't be too soon, because the only thing that could make it go ballistic soon is literally ballistic, would be China and America not getting on, because that's what it was all about. And that situation got delayed or cancelled just after, January, February last year, when Xi fired his generals. Gold is full war. He fired his generals. No war. Not next year when it was planned for. So all of a sudden, everybody says, well, maybe you don't need to get so much gold in for this war that's coming next year, because maybe it's not coming. So maybe we should just let it ride for a bit and see how it goes. And, he's going to go to New York in September, so everything will be kumbaya then. God will go like that. Well, if he goes to New York and there's a few spicy words with a certain Donald, it could go like that in October. But I don't think that's going to be what's going to happen, because all China has to do, and I believe that's what this is now their strategy. And, I bumped into somebody making a joke about this, and I went, yeah, that's right. Yeah, do nothing and win. All they have to do is do nothing, and they've won. So all they've got to be is, oh, yeah, sure, yeah, okay, no problems, yeah. We'll let you have some rare earths. Yeah, I don't care if you make weapons with it. Yeah, we're kind of cool about that. Yeah, we're dominant in robots now, so what do we care? And AI, we just distilled all your AI. We just stole it all, so, yeah, we caught up with that as well. Yeah, and we make all the stuff. We've got 2.5 times more energy than you. Yeah, we'll be relaxed with you. You can be our friend. And, gold won't go up. But if America goes, we're not having any of this. No, we are the big I am. Donald says you're all a bunch of swines. And, she goes home and it goes like that. Oh, dear, that won't be good. But it could happen, but I don't think it will. I absolutely don't think it will. So it will be going dibble. And they'll be saying, we're very hawkish on interest rates. We are very hawkish. They haven't gone up, but we're very hawkish. Oh, we printed loads of money. Oh, no, that wasn't us. We didn't do it. Oh, we printed some more. Oh, yeah. Oh, well, those numbers, yeah, it's a one-off. It's a one-off. It's something else. It was always in the numbers. It was always going to happen. We won't do any more. Oh, we've done some more. Then everyone go, oh, no. That lunatic on that show talking about them printing money like no tomorrow, he was right. Buy gold. But it's going to be a bit of time. It had its day. At the beginning of the year, silver and gold had its day. You can see it doing that over the years, back since the 70s. And all commodities, they have their day. Even chocolate. And it goes, boom, crash, bang, wallop, and everyone forgets. It happened to chocolate 7 years ago. It was about 7 years ago, wasn't it? Mr. Chocolate Finger, as he was called. And, chocolate, cocoa, what was that? And it'll do it for the potatoes, and cotton will do it, and lumber will do it. I was actually in Chicago walking around the exchange when the lumber market exploded 20 years ago, whenever it was. And there was all these old men in jeans looking like, Grizzly Adams, and they traded lumber. And they were having their moment, and lumber went shoom, and it went shoom, and it went shoom. They all do it. You can see it in the charts. Go look. And gold and silver did the next one of that they would do, and it'll be a few years before they do it again. But copper hasn't done it yet.
Digging into some of the data around gold, from the World Gold Council's latest figures, we can see that gold demand held steady at 1,269 tons during the second quarter. But there's a striking divide in that gold-backed ETFs are suffering outflows, whereas investors keep on buying bars and coins. So what does that split tell you? Why do you think that there's more physical buying going on at a moment when ETFs are seeing big outflows? Why would that happen, do you think?
Well, maybe they sell their ETF and buy some bars, or sell their ETFs and buy a few coins. I mean, you know, if you actually look into the numbers on gold, yeah, every year. By the way, the supply's gone up by about 100 or 200 tons since the last time I looked. It's now 3,300 tons rather than 3,100 or 200 tons. Now, if you think about that, 3,200 tons of gold, a ton is roughly 100 million, right? That's 32 billion. It's a lot of billions. It's a lot of billions. So there's got to be a lot of billions that come out to buy up all the new gold. Yeah. So what is it? Ton 3,200, 320 billion every year. More cash, more paper for that gold to stop the prices going down, to keep supply and demand into balance. That's a lot of money, even in this day and age. Yeah. Now, another way of looking at it is how much of that gold, of that, whatever it is, 320,000 tons, is free float, i.e. you can buy. It's actually in circulation. Well, if you think half of it maybe, or a third of it maybe, gold being produced right now is about 3 or 4% of the free supply of gold. Well, that's like saying 3 or 4% inflation. So gold is an inflationary monetary system of about minimum 1%. So the inflation of gold is 1%. And as we know, inflation creates devaluation. But what I just said is absolutely antithetical. If I was amongst gold bugs, they would be dragging me off to hang me out the window by my toes for that. But nonetheless, that's the thing. Yeah. So, gold, people buying coins and bars and not buying ETFs. Well, actually, that's a shift away from the serious game into the land of the retail investor that takes out his 1 ounce coin and goes, I love my 1 ounce coin. I've got 3 of them. Yeah. And that's not really what drives the market. What drives the market is Poland going, oh no, I've got Russia next door to me and I'm scared and I'm going to need to be buying weapons. And if the balloon goes up, the only money they're going to take is gold bars. I think I'll have another 2 tons, please. And that's what's been driving gold. Governments buying gold as backup currency for conflict and danger. Yeah, because gold is for war. And on top of that, to cap it all, and you have to dig deep to find this. Yeah. So I'm a mullah. All right. And I want to be buying your little paper planes that go bang and all those engines that go in them, because I don't make no engines. I don't make no electronics. I don't do any of that. I just buy it off China and I screw it together. All right. Now, fortunately, I've got this oil stuff and I send them the oil. Yeah. And they get the oil and they pay me, and they pay me in gold in China. They've got a vault for me. It's got Muller PLC over the top of it. And when I send them a tanker of oil without its transponder on, they go, right, you just earned yourself 1.5 tons or whatever it is. Yeah, let's call it 5 tons of gold. And that gold goes into my vault. And when I want to buy some paper planes that go bang, they take some gold out and say, we've debited you some gold at the dollar value. Yeah, because if you get dollars, something nasty might happen to them. And by the way, I can't ship you dollar bills in a plane because something nasty might happen to them, but I can ship you gold bars. So places like Russia and places like Iran and anybody, North Korea, funny enough, not very far away from that country. Yeah. When they do trade, it does what Hawala always does, what bankers always do. The money don't move. Oil might move. Yeah. Trade might move, but the money stays in the vault, and the vault is gold and it's in Beijing. So that's been driving the trade as well. So we've had all that. But the main thing is countries going, oh, dear, this is getting a bit spicy. We've got a lunatic here and we've got a lunatic there, and they don't like each other and things could get nasty. We need some, currency during wartime. Now, on your way to war, this is the key thing. Gold is for war. Gold is for war. Because in war, you spend it. But if you ain't got it, you got a problem. So when you lead up to war, you got to buy it. And when you're in war, you've got to confiscate it and steal it and do all sorts of stuff. Yeah. But why? Because you're spending it during a war. Oh, funny enough, Russia's been selling gold. Oh, funny enough, Turkey's been selling it because they're up a creek without a paddle economically, so they better start selling down their gold. Yeah. Oh, funny enough, Iran undoubtedly will be selling it, and probably all that Bitcoin they mine too. Yeah. So there's a downward pressure on precious metals, particularly gold, during conflict, like you've got in Iran. Yeah, like you've got with Russia. But on the road up to a really big conflict, like America versus China over Taiwan, oh boy, you're going to get gold going that away. And then when suddenly that's postponed, it's going to go that away. And then when people come out and start selling it because they're at war, it's going to go that away. So, you know, it would take a very bad visit from President Xi to New York in September to change that picture. But, you know, you just look at the charts in the past. Look at 1980 or whenever it was when it was $800 an ounce. Yeah, you see, it went up like a rocket, came down like a rock, went to sleep. And that's what commodities do. And sometimes they have an echo. So if you go back into the 70s and look at the commodities that went up like a rocket, down like a rock, went to sleep, 2 or 3 years later, they went up like a little rocket and then came down like a rock and then went to sleep. And there will be an echo. And it will be, I don't know, go pull the charts of the 70s, you'll see it. 2 or 3 years. There'll be a lesser one. It will go, it's going to do it again. Yeah. Oh, it didn't. Yeah. But elevated inflation, you know, the confetti being devalued slowly but surely 5 or 6% every blooming year, economic boom to go along with it, massive economic boom. So if you're active, you'll be making like a bandit and inflation won't touch you. But if you're not active and you're passive, you're retired, or you think you've made enough money to retire on, ooh, difficult.
We get close to wrapping up this week's episode. I want to play a couple of games with you. And the first one is called Date, Marry, or Run. And your choices are
Take, marry,
gold,
or run.
date, marry, or run. And your choices are gold, copper, and natural gas. So which would you date for a short-term trade? Which would you marry as a long-term investment? And which would you run from? Gold, copper, and natural gas.
I wouldn't run from any of them. I would run from natural gas because it will rip your face off. And I don't like commodities that will rip your face off. So you can make a lot of money in natural gas, but I think natural gas is the commodity that's known as the widowmaker. And the widowmaker. I do have a wife, and it would make her a widow. So yeah, so I'd avoid that, not because it ain't going to go up, just because the volatility is such that, you know, I'm too old for trading. I burnt my stomach lining off decades ago, and so playing those sort of games, which I was really good at, but my digestion didn't agree. So I would run from natural gas purely on the basis of the fact that it can rip your face off, and does regularly to traders.
And the second game that oh no, but you didn't finish answering the question, sorry. So gold and copper then, which one would you marry and which one would you just date?
Well, I mean, I suppose as gold really is a stacker thing, and you long-term stack it, in your metaphor, you would marry gold. But I think I'd prefer to stay single. Yeah. And I would definitely date copper, because copper's going to go wild. And I like them wild.
Okay. So if you had
I mean, you
to
know,
marry
I
one, it
think
would be
gold is a
gold.
bit plump. It's a bit plump, a bit frumpy for me for quite some time. And if I don't have to marry her, then I think I would stay single.
You got some commitment issues shining through here.
Definitely with gold. Definitely with
Yeah.
gold. She was lovely. She was lovely. But now, you know, like many a rich man, you trade her in for a new model, right? And that would be copper. So maybe marry copper. No, because it's going to go up like a rocket, down like a rocket. It'll be like gold. And, you know, I'll have a new vacancy after it starts to come that way.
All right, excellent. So I'm going to take from your statement that you're marrying gold, dating copper, and you're running from natural gas. And I'd like to invite our listeners to write in the comments what to include in next week's Date, Marry and Run segment. And before we finish, of course, the $1 million model portfolio. So the segment probably now needs to be renamed because we're down to about $960,000. We've been underperforming the market, actually. Every week we ask the guest on our news show to make one change, which is to sell $100,000 of something that we already own, and then to reallocate that into the asset that they think has the best long-term setup from here, which could be anything as long as it's listed and investable. So a stock, ETF, ETC, or something, as long as it's not too complicated for us to track in our portfolio, basically.
I can wreck your portfolio by suggesting some bad ones.
So I'm just gonna leave you to think a minute about. You can see what we're holding in our portfolio there, and I'm just
I
going
do have to sell one for you as well.
Yeah, so you need to sell $100,000 of something and then reallocate it. And just while you're having a think, I'm going to remind our listeners about the recent trades. So we had Steve Hankey, who sold bonds and he bought gold. We had Simon Hunt, who sold global equity and he bought gold. Peter Schiff, who sold bonds and he bought gold. David Morgan, who sold bonds and he put that into the Silver Miners ETF, and he also bought Freeport. And having a look at the portfolio, so we're down 5% on Freeport, and on the Global X Silver Miners ETF, we're down 16%. And on our gold holdings, we're down 14.5%. We also had Adrian Day, who was on the show, and he sold Energy Transfer, which was something that Doomberg had bought, and we're slightly up on what remains of our Energy Transfer holding. And Adrian Day, I believe he bought gold. No, what he bought was an emerging markets ETF. That's what Adrian Day bought, and we're down 2.2% on that so far. We also had Lance Roberts on, who sold global equity in order to buy the S&P 500. And the S&P 500 in the next episode was then totally sold off by Michael Oliver, who bought more of the Silver Miners ETF, which, as we said, we're down on. And Michael Howell bought $100,000 of an agricultural ETF, which we are up 4.1% on. So, okay, having a look then at our holdings, what do you not like the look of? What would you sell $100,000 of?
Well, it's totally unbalanced portfolio. It's a concentrated portfolio of precious metal risk and commodity risk. So that makes it suck right there. Now, you can make a load of money that way if commodities go through the roof, which they could well do. So, but you know, it's not really a portfolio. I mean, it's a bunch of things. It's not a portfolio. You've got no dumbbell there. It's just, yeah, we like commodities, we like gold and silver. Let's go. I mean, yeah, why not? But I mean, the other thing is, there's no good putting in a position here and some, guy will come along and go, "Oh, I don't like that, knock it out," because this is a trading portfolio. So what you're asking me to do is pick something that's going to move in the short term, or not too distant term. Because if I go and put, I don't know, Nvidia in there, you're going to have a gold bug come in next week and knock it out again, and it's gone down 3%. What a woolly that guy is. So this is very tricky stuff here. Now I would say it's full of gold. Now you're going to get a gold guy in next week, and he's going to knock out my idea and put gold in. So it's there you go. But short term, and I mean by short term, maybe 8 weeks. Okay, medium term, 6 months. I'm going to not please your audience. I'm going to throw in IBM, and there's a good chance that they'll go mental. But it's only because of AI. So you need a bit of AI in there. And, you've got so much gold. I mean, you might as well just say gold and forget the rest of it. And, so what you've got, Vanguard, total world stocks. Well, that's the whole world. So that might as well be the S&P 100. But it wouldn't be. But, that's as dull as ditch water. Mind you, it's not. It's gonna perform-ish because it's the world, right? So probably, but it's not going to go down. gold is going to go down, isn't it? It's going to go down 10%. So that's probably it. Silver is going to go down 10%. Food, probably not going to go. It could go up quite a bit, actually, because obviously Hormuz has meant there's fertilizers is a bit wrecked. And that's not so great. I think Europe's going to have a great crop. I might be totally wrong, but looking out my window, it looks like there's plenty of crops. When I look out my window, they're doing quite well. Lots of grapes. If your vineyard doesn't get burnt down, of course. So then you've got FTSE emerging markets. Well, I mean, anybody could do a career tomorrow. So you wouldn't want to bet against that. And it's 9% of your portfolio, so it's relatively good. Europac Gold, is that just gold?
It's a mutual fund run by Peter Schiff's company. He chose to add that actually, and
But it's gold, yeah?
it's a collection of gold miners.
Oh, get rid of that then. Right, there's 81 grand of it. But I mean, gold miners, yay, gold goes up. They don't. I mean, I have an involvement with a website called Priced in Gold Elite, and it prices everything in gold, absolutely everything in gold. Pricedingoldelite.com, right? So you can go and look at NVIDIA in terms of ounces of silver and how it's done. It's basically the benchmark is not dollars, but gold. So then you pull up a gold mine and you price it in gold, and as gold goes up, the bloody mine goes down. It's like, what? They should be totally correlating. Total correlation. No. Yeah. Because the gold mines, which are meant to be levered, they're meant to outrun the price of gold because obviously their margins go up, right? No, gold mines don't perform when gold performs. I can never see it do it. Or it does crazily for one stock out of four. So yeah, it can that one. Sorry, Mr. Schiff.
All right, so you've raised 80,000, let's say. So you need to sell 20,000 of something else in order to get to your
well,
100,000.
Well, I mean, it's all gold. It's all precious metal, isn't it? So, well, it's not. It's all this. It's all these ETFs that are going to go up, and you've got 300 grand. You've got a third of it in international indexes. Okay, so you're going to end up, if you're not careful, having just having the S&P 5, well, not the S&P 500 because it won't be quite as good as the S&P 500. But anyway, yeah, absolutely, people should do that. But you don't want me to come on here and just say, buy the S&P, go away, forget about it. That'll do. You're too thick to do anything else. Well, I'm almost too thick to do anything else, but I don't. So I would say, logically, if you want a bit of spice. So anyway, bung in 100 grand of IBM because you're going to get spicy. That's a bit of, you need a bit of zap in here. Cheap AI zap, and that's IBM. And what's this thing at the bottom? Energy
transfer.
Is that a company?
Yeah, so there's a company involved in mining, or I think so.
Okay, well, I can't knock them out because I don't know who they are. And if it's anything to do with energy, it's probably going to be golden because there ain't enough of it.
Is that green chicken? Have you seen that green chicken Doomberg on YouTube? He runs a newsletter.
I know of him.
Yeah, he was the one who chose that.
Well, I'm not gonna go up against a green chicken, particularly one that is, he's a contrarian, right? So he's a brother contrarian. So yeah, I'll leave it because energy. It's going to be a big, hairy deal. And it seems, incredibly, the market hasn't woken up to just how much of a thing that's going to be soon. If, of course, America continues to want to be dominant and wants energy dominance, and they don't kick out Trump and his crazy crew and put in a load of surrender monkeys, which could happen. If the surrender monkeys in, you can forget energy. It will all be over. Long live Romulus Augustulus. And people need to look that one up and they'll get what I mean. So anyway, be that as it may, so bung IBM in there. You got enough stodge, so knock out what was that fund? Yeah, knock out $19,000 worth of global benchmark.
So okay, excellent. So we're selling off the Vanguard Total World Stock ETF as well as the Europac Gold.
No, get rid of the whole of the Europac. That's 18.
All of it.
80k of rubbish miners, and then 82 of rubbish miners, and then you only need to get rid of 18 grand out of 288 because that's the 30% of your portfolio there. It's really just stodge. Really, that's just money that's parked in not doing anything but as a benchmark. So the global benchmark, put a third of your money in the global benchmark. Wow, great. It's good advice if you're a muppet. Stick it in that. You won't go far wrong, apart from maybe you will. But that's ETFs are for boring, and for not having to bother with any of this stuff, and capturing the global market's growth. So that's great. But if we're playing a game here, you want to get alpha, and to get alpha, you just can't have stodge. You won't get alpha. You'll get the benchmark, which is great. The benchmark's great. No two ways about it. I love the benchmark. But if you want to outperform it, you want to turn that down, turn up the risk. And so I'm knocking out a bit of Vanguard, because it's too much stodge in this portfolio. It needs a bit more spice. IBM is pretty spicy, even though it's a huge company and it's going to do massively well in AI, etc., etc., etc. Most people say, "What you're talking about? They just dropped 20% more than they've ever dropped in a day." And I say, "Yeah, that's why I want to buy it." So that's a bit of spice, which is 10% spice. So you've got stodgy stuff that's going to go down with gold, stodgy stuff that's going to go down with silver. You've got agriculture, which should be good. Who knows, a little bit wobbly. Emerging markets, that's going to be good. That's going to be nice. It's going to be a little bit spicy. You've got FTSE emerging markets. Oh, that's what I just said, wasn't it? Yeah. We're getting rid of the junk. Freeport McMoran, I own them myself. They're spicy. They're a great copper mine until one of their mines suddenly floods, and they have to shut it for 2 years or whatever they've had to do. But nonetheless, copper is golden. There you go, a new catchphrase. They are one of the big hairy deals in copper. So yes, that's spicy. I like big spicy. Pays a dividend spicy, I believe. So are you counting dividends? Don't forget to count your dividends.
Sorry to interrupt you. Before the show started, I believe you said that you actually had a UK stock in mind as well that you might mention. Would you like to name that?
That I could name it, but I wouldn't put it in this not portfolio. Model lump of precious metal that you call a portfolio. Yeah, I mean, in the UK, no, it's not apt. I'm going to name one company that I wouldn't put on this list that is apt, right? And that is, and I always get the name wrong, so I've looked it up to make sure I don't get it wrong. It's Neo Performance Materials, which is, I feel, the best rare earth company out there that you can get a position on. It's up by about 50% since I bought it. So, I mean, it was up 100% before the summer. And they're one of the few people that are integrated enough to make rare earth magnets outside of China. And they do, and they used to be part of Mountain Pass. They used to be the execution, take our minerals and do stuff with it, part of Mountain Pass. And then when Mountain Pass went bust all those years ago, they got span out, and they used to be called Neo Magnequench. That's a mouthful. And they're now called Neo Performance Materials, and they know their stuff when it comes to rare earth and making magnets. They are pretty much, in my book, the business when it comes to rare earth and rare earth magnets. So I hold that one myself. But you ain't got a portfolio the right shape for that, because 10 doth not make a portfolio, mate. It does not. You've got to get to 20 even to cover your arse a little bit. And 30 is where you need to be mathematically. Yeah, 10 is, oh, wow, oh, that's not a portfolio. It's not a diversified portfolio of risk, especially when it's full of blooming precious metals. I mean, you've got a lump of stodge.
10, 30, what do you mean by that? Sorry.
Okay, portfolio is about building a risk profile, a risk horizon, a risk surface, so that you are protected from blunders, effectively, and to be protected from wacky stuff, from Trump's happening. Yeah, and for that you need to have a balance of different types of correlated and uncorrelated or less correlated risk. Okay. And for that, you really need to have a smattering of rando stocks across 30 different stocks. Yeah, equal weight.
Well, in that case, wouldn't that be an argument for you putting 50,000 into IBM and 50,000 into this rare earths play that you just mentioned? Then we could increase the number of our holdings.
If you want a bigger table and you want to have it in, that will fit on your YouTube. And people will be able to read it. Sure. Yeah, I wouldn't disagree with that. I wouldn't disagree with that. I thought the 10 was what was your limit.
No limit. We're building as we go. It may be a case of
Oh
too
yeah.
many cooks spoil the broth, but hopefully the
Well,
collective
actually, it might work
intelligence of
better.
our guests.
Okay. Well, I can give you 10 right now, and then you can boost it out to 20.
No, that's fine. We'll just stick with those two for now. But we appreciate your contribution and we will be tracking it and we'll see how they perform. Hopefully no one will sell them off before we get a
Well, if
fair
it gave
shake
another
of them.
10, it'd take them longer, wouldn't it?
Yeah. All right, Clem, thanks so much for coming on the show. Is there anything you'd like to leave the listeners with? Any thoughts or where they can go to follow you and your writings and thoughts?
Well, they can see my data platform at an UFN. It would be particularly useful for UK people because we have a real-time level two and real-time prices, which will cost you about £1,000 a year to get from anyone else, and it's free with us and always will be. So that's and you don't have to do it. You don't have to give us any money. You just have to go and pretend that you're not I shouldn't say it like that. I said you have to establish. I didn't mean pretend. Honest. Establish that you're a private investor by saying that you are one. So no professionals, please. So that's a lot of value. So I would encourage people to go over there. And I have a podcast channel on YouTube, Clem Chambers Alpha, and if you're UK, Clem Chambers UK. And my Substack is where I put absolutely everything, and that's very popular. And you can be guaranteed to hear things that you won't hear anywhere else. And that's really why I do my stuff, is because the money is not in the mainstream narrative. And the money is in not being exit liquidity. And I've got no fund to sell. And I've got no PLC to push the shares on. I'm not a spokesman for a fund or anything like that. I do it because I used to do it for a couple of decades with another site which was all about leveling the playing field for the private investor. And I'm still doing that. I get a kick out of it. And it forces me to think and crystallize my thoughts doing this. And therefore, it forces me to crystallize my investment strategy, of which is what, enables me to live in Monaco. So, and people who are on my channel will go, oh, he keeps making ideas that go up. Oh, and, they're all there to see for free. How about that? You can see it's all for free. And I used to write. Sorry, that's another Freudian slip. I write for Forbes for 20 years, and you can see all the stuff I predicted, all the way back to the .com-ish kind of period, all the tops that I called, and all the bottoms that I called, and the bottom. Gold, when it took off, I wrote that in Forbes just as it took off, just as it made the first breakout, and I wrote about it all the way up. I wasn't predicting the past like a lot of people. I was predicting the future. You can read it all. And when it got to the top, I got out. And you can read me getting out. You can read everybody saying what an idiot I was. Didn't turn out like that, did it? So go check it out.
Clem Chambers, thanks again for coming on the show.
My pleasure. I look forward to being on again and me being wrong and you telling me off.